David, we talk about crypto and the boom bust cycle happening every 4 years. And of course, this is sort of our base prediction. Yeah, a 4 year cycle. And so like, we are getting into the bull territory of this full 4 year cycle. The reason that many in crypto have always pointed to for this 4 year cycle that I have not fully bought into is the halving. Because it turns out that the Bitcoin halvens its supply about every 4 years. And of course, the magnitude of that as a percentage of Bitcoin supply is decreasing over time. This is the tiniest halving yet in terms of total Bitcoin supply. But still, that's one of the reasons given for 4 year cycles in crypto. Mike Ippolito has a different take on that. Maybe the 4 year cycle is not caused by the Bitcoin halving. Maybe it's something else. What are we looking at here?
We are looking at a graph that basically looks like a sinusoid. It is a wave going up and down in the background. It's just like a model for a sinusoid. And then there's a chart in front of that sinusoid that is the global liquidity index, as in how much liquidity is there in the global markets around the world. And that line is a little bit more choppy, but it generally follows that 4 year sinusoid in a very rough fashion, but like the pattern is pretty clear. And then if you just look at this in the crypto context, right, we had the 2013 fork and fair launch bull market, which was at the peak of the rise and the peak of the 2013 to 2014 sinusoid. Then we had the 2017 bull market, which also same thing. And then also we had the 2021 peak as well. And so it all just lines up with liquidity. And I think this is the big conclusion that people got to after Bitcoin went from like 69,000 down to 20,000 as inflation set in, where everyone was like, prior to that, everyone was like, Bitcoin is an inflation hedge. And then inflation happened and Bitcoin went down because interest rates went up. And turns out we are now remodeling our idea about what Bitcoin is. It's an index for liquidity, which is exactly what this theory would say.
Yeah, I think that's right. And I think this sort of explains crypto 4 year cycles even more than Bitcoin. I will point out it could be both, though, right? It doesn't just have to be one thing. But I do think that worldwide global liquidity is kind of the big explainer here. And just to give a sense of what this global liquidity index is based off of, it's basically the central banks of the world. So all of the central banks, so that's the Fed, central banks of China, Japan, EU, all of them, and also commercial banks. They are kind of the levers or control mechanisms for how much liquidity is in the actual market. So at the end of 2023, we had a global liquidity of about $170 trillion. And that is on pace to rise in this cycle. So we're at kind of the trough of global liquidity and now making our way up as more liquidity is injected by the banks into the market. That is what this trend line kind of predicts. And those are the waves that you were just saying.
I want to double down on that punchline. We are past the trough of the recent sinusoid and we are on our way up. That's kind of that's where we are in this trend. And so if it was as violent of an uptrend as it was last cycle, we have a long way to go in terms of more liquidity coming into the markets, which always impacts risk assets the most, which is crypto. That's us.
I mean, you could see this on other charts too. This is a comment from Mike's tweet. If you know this, but Satoshi was actually a macroeconomist. It's so interesting how the Bitcoin 4 year halving cycle is also timed with these 4 year like cycles of liquidity in and out of the market. And it goes to show, David, like one thing that's always true of markets is it's all about inflows and outflows, isn't it? Right. And so fundamentals make their way into prices over time, but in the business cycle time range, like the 2 to 5 year time range, it's all about liquidity. And so, I mean, this looks very bullish for crypto assets and then probably risk on assets in general. And, the punchline here is it's actually less about interest rate. So people look at the interest rate and they're like, it's 5%. It's 5%. That's high. It's higher than it's been in the last like 10 years, right? It's not just about interest rate, guys. It's also about the liquidity that is sloshing around in these markets. And it looks like all of the banks are ready for another cycle of money printing.
Speaking of inflows and outflows, the GBTC outflows have slowed this week, especially in the last 2 days. So the 29th, 30th, and 31st have been some pretty notable changes in tune in the Bitcoin ETF world. So on net, There was negative $17 million outflows on the 29th between all of the Grayscale outflows versus the other ETF inflows. On the 30th, which was Tuesday, there was $378 million inflows into all of the Bitcoin ETFs. And then yesterday, at the time of recording, the 31st, $240 million inflows. So over the last 2 days, we've had over like $600 million of inflows into the Bitcoin ETFs, which have surpassed all of the Grayscale outflows. The Grayscale outflows on the 29th, 30th, and 31st, 289, 192, 170 million. So that number of Grayscale flowing out, GBTC flowing out of Grayscale to Coinbase, being sold, turning all these candles red, is slowing. That is a lower number.
We needed to get rid of all of those outflows in order to resume the ascent upwards,
Right.
didn't we? And it might be no accident that this week we saw a 7% gain on Bitcoin, and these outflows have started to halt and stultify. So that's good. That's healthy market activity. That's what we need in order to go back up.
If you enjoyed all of that, then you'll absolutely love the Bankless newsletter. Join over 300,000 fellow readers, all for free. Click below to sign up.